Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden language of corporate filings. Today we're diving into Cardinal Health's latest 8K report, and let's just say they're playing a new tune with their debt. This little document is basically a company's way of shouting out important news as it happens, and Cardinal Health is here to tell us about a significant financial move they've made. They've just completed a massive public offering, essentially borrowing a ton of money to fund a big acquisition. So what's the big deal here? Well, Cardinal Health, a major player in healthcare services and products, a company that touches almost every aspect of the healthcare system from pharmacies to hospitals, is raising a cool $1 billion. That's a lot of zeros, and it's not for fun. They've issued two types of notes, which is just a fancy way of saying they've sold bonds. The first batch is $600 million in notes that they'll have to pay back in 2030, and these come with a 4.5% interest rate. Think of it as borrowing money with a promise to pay it back with interest by a certain date. The second batch is even bigger. It's $400 million in notes due in 2035, and these have a slightly higher interest rate of 5.15%. So they're borrowing more money for a longer time and paying a bit more interest on it. Now, why are they borrowing all this money? The filing clearly states that the proceeds are going towards a big acquisition. They're buying a company called Solaris Health. This acquisition is clearly a strategic move that requires a significant amount of capital. This is how companies grow sometimes, by buying other companies to expand their services, reach, or technology. But here's where it gets interesting and a little risky. What if this Solaris Health deal falls through? The filing has a clause for that. If the acquisition isn't completed by a certain date, which is August 12, 2026, or if Cardinal Health decides not to go through with it, they have to buy back these notes, and not just at face value, but at 10.011% of the principal amount, plus any unpaid interest. This is called a special mandatory redemption. It's like a penalty for the deal not happening, and get this, they're not putting the money into a special safe account while they wait to see if the deal happens. They can use the money for general purposes in the meantime. This means if the deal does fall apart, they'll need to scramble to get the money back to redeem these notes. It adds a layer of complexity and potential disruption if things go sideways. The foundation for these new notes is an older agreement, an indenture from 2008, which serves as the main rule book for their debt. Then they've added to it with a third supplemental indenture specifically for these new notes. It's like building an addition onto an existing house. You have the original structure and then the new plans. This specific attachment details what those 454.50 notes due in 2030 actually look like. It's the legal document defining the terms of that particular debt instrument. Even their legal team is weighing in. The Executive Vice President, General Counsel, and Secretary is providing an opinion on the legality of these notes. This is standard practice, essentially the company's top lawyer saying, yes, this is all legal and above board. This section is essentially confirming that this action creates a direct financial obligation for Cardinal Health. They've borrowed money and they absolutely have to pay it back. It's not some hidden or secret deal. It's out in the open as a concrete debt. This refers to the original indenture from way back in 2008, which is an important foundational document for understanding their debt structure over time. Now, let's look at the bigger picture. Cardinal Health is essentially betting big on this Solaris Health acquisition. Borrowing $1 billion is a massive undertaking. They're signaling confidence in the deal and its potential to boost their business. However, the clock is ticking on that acquisition. If it doesn't close, they'll have to return a significant amount of money, which could strain their finances temporarily. The interest rates they're paying, especially for the longer term notes, are not insignificant. 5.15% for the 2035 notes means over the life of those bonds, they'll be paying a substantial amount in interest on top of the principal. This further amplifies the importance of the Solaris Health acquisition succeeding. Think about it like this. If you borrow money to buy a new piece of equipment for your business, you expect that equipment to generate enough revenue to cover the loan payments and then some. Cardinal Health is expecting Solaris Health to do the same for this $1 billion loan. The fact that the funds aren't in escrow is a bit of a double-edged sword. On one hand, it allows Cardinal Health the flexibility to use the funds immediately for other corporate purposes. On the other hand, it means they need to manage their cash flow very carefully, in case the acquisition falls through and they suddenly need to recall those funds. Looking at Cardinal Health's overall strategy, this move clearly points towards expansion and consolidation within the healthcare sector. Acquisitions are a common way for large companies to maintain growth and market share. By acquiring Solaris Health, they likely see synergies, cost savings, or new market opportunities that justify the significant debt they're taking on. However, a key risk here is integration. Merging two companies, especially in healthcare, where regulations and operations are complex, is notoriously difficult. If the integration of Solaris Health isn't smooth, it could lead to operational disruptions, increased costs, and lower than expected returns, making it harder to service this new debt. From a Warren Buffett perspective, you'd want to see a clear economic moat around the combined entity and a management team proven to execute acquisitions effectively. We'll need to watch how gracefully Cardinal Health integrates Solaris Health and whether the promised synergies actually materialize to justify this debt. In conclusion, Cardinal Health is making a bold move with this billion-dollar debt offering to fuel a significant acquisition. The success of this strategy hinges entirely on the completion and effective integration of Solaris Health. If the deal goes through and delivers its expected results, this could be a great step forward for Cardinal Health. If it stalls or fails, the company could face financial headwinds due to the redemption requirements. It's a high-stakes gamble that highlights the aggressive nature of growth in the healthcare industry. What's your take on Cardinal Health's massive borrowing spree? Are you optimistic about the Solaris Health acquisition? Let me know your thoughts in the comments below. If you found this breakdown insightful, please give this video a thumbs up and don't forget to subscribe to Corporate Decoder for more sharp insights into the world of business. Also, join our growing community on Discord. The link is in the description. Thanks for watching and I'll see you in the next decoding.